This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performances do not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk. There's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading.
Good afternoon, traders. I'm Scott Norris here to wrap up the day, the week, the month, and the quarter for you. Today is Friday, March 30th, 2007. This is your Forex report. The market was a little disappointing this week in terms of movement, with most majors confined to tight ranges. U.S. data was very well spread out over the 5 days, with testimony from Fed Chairman Ben Bernanke in the middle of the week. We kicked things off Monday with new home sales, which fell sharply to an annualized pace of less than 850,000. This pushed the greenback lower after having found strength at the end of last week. More disappointing data came out Tuesday morning as consumer confidence fell a second month in March, in turn adding pressure to the buck. However, the greenback found some solid support midweek as Ben Bernanke testified on the economic outlook before the Joint Economic Committee on Capitol Hill. During the reading of his prepared comments and through a question and answer session, Bernanke firmly backed his previous projection for moderate growth in the U.S. this year. Furthermore, the Fed chief said that the FOMC has not left its inflation bias and rising prices remain the predominant concern. This prompted futures traders to pair bets on first-half rate cuts, which gave the dollar some much-needed buoyancy. Better than expected GDP and PCE numbers released yesterday and today helped keep the dollar firm as we headed into the final stretch of the week. Just as we thought things may remain flat through the end of trading, the U.S. Commerce Department made the announcement today of new duties on Chinese imports. The decision came after months of debate and is intended to level the playing field for U.S. paper manufacturers. Of course, this decision scared investors into selling the dollar aggressively out of fear that China would retaliate by purchasing fewer U.S. treasuries. In less than 1 hour, most currencies had gained more than 100 pips on the buck. This leaves the dollar ending the week on a sour note and could possibly have even greater implications in the long term. Now to the big picture. It appears there are mixed opinions about how much today's announcement from the Commerce Department will harm the dollar in the big picture. While we have seen an immediate reaction of dollar weakness, most pairs have not broken major support barriers for the greenback yet. We will likely get a better feeling for its longer-term effects by the market's reaction in the first 48 hours of trading next week. If we see intense dollar selling right out of the gates, it could be a bloodbath all week long. In the meantime, at least dollar bulls have inflation concerns to hang their hats on after Bernanke remained hawkish on Wednesday and PCE surprised to the upside today. Of course, it does not seem like enough to give the dollar any sustained strength or momentum. This leads us to believe that rallies in the U.S. dollar will be seen by the majority of traders as an opportunity to short the currency rather than jump in on the long side. The technical picture, while mixed this week, is still very bearish for the greenback in the broad market. Furthermore, today's sell-off gives the weekly charts an even sturdier look for additional selling as we enter the second quarter on Monday. Till next week, have a great weekend. Take care.